Hello, everyone, and welcome to Discovery 2025. This is our economic update where we'll cover what we expect to happen with the economy going into 2026 to help you form your strategic plan. And we'll be looking at the economic environment and what impact it'll have on your credit union's balance sheet, its deposit growth, its loan growth, how interest rates may be moving up or down, and will the economy go into a recession or not? So let's jump right in and talk about some of the new economic policies we have from the latest administration and what impact that'll have on this economy. So we'll take a look at some of Trump's policies and the impact. Number one is the universal tariffs. We'll just in general put out a 10-20% universal tariffs. What impact could that have on the U.S. economy? Well, I'm going to use a little color code here where red means not too good, a little bit harmful for the economy, where green is good. As you see, tariffs will typically have an inflationary impact. So expect a little bit higher inflation than we would have had without the tariffs and a little lower GDP growth. The good news is in green, we could have lower deficits. Of course, tariffs are a tax and taxes will bring in more tax revenues. Lower deficits, that could lower interest rates, specifically the 10-year treasury bond, that could help the mortgage business out. Number two on our list, looking at mass deportations. As you know, Donald Trump said maybe we should deport 10, 12 million undocumented workers. What will that do? Well, it'll tighten the labor market, reduce the supply of labor, push up wage cost, make it a little bit harder to find employees. Will that do to the economy? Well, a little bit higher inflation, lower GDP growth, and higher deficits. Notice this is one of those policies that kind of have a lot of negatives when it comes from a pure economic perspective, not talking about any cultural, social, political aspects. Number three on our list, we just passed the 2017 Tax Cuts and Jobs Act, or extended that act with the new big, beautiful bill that just recently passed this summer. So we extended these tax cuts. Well, what will that do to the economy? Well, basically in green, it's good. It typically will lead to higher GDP growth, so a little bit faster economy, a little bit higher inflation, because it is a tax cut. People will have a little bit more disposable income and basically go out and spend that. But it will mean higher deficits because it is an extension of these tax cuts. So deficits will be higher than what we thought. That will be pushing up interest rates. Number four on our list, no tax on tips and overtime was recently passed in that big, beautiful bill. What's the economic impact there? Very similar to what we saw earlier. A little bit more inflation if people have more disposable income, economy growing a little bit faster. But of course, it is a tax cut. And so deficits will be higher, pushing up interest rates. Maybe mortgage rates will be going up, slowing the housing market. Number five on our list, deregulation, elimination of red tape. This is one policy economists can really get behind because if you notice, there's greens across the board here. We have lower inflation, higher GDP, and lower deficits. So one of those rare policies that has really good positive implications for the economy. Number six, reduction of the federal employees. We can call this the Elon Musk effect, or if you will, the Doge effect, the Department of Government Efficiency. You know, there was layoffs of 10, 20, 50, 100,000 federal employees. What will that do to the economy? Well, basically lower inflation, fewer people working, they're not spending as much, a little bit lower GDP, less goods being purchased, but also lower deficits. If you're not spending as much on these employees, that will be less government spending and it will lower the deficits. So if you look at the picture of their reds and greens, we kind of have a mixed bag, if you will, with the new Trump policies. What we can take away from all this is the following statement, that concerns about stagflation are rising, where the economy is stagnant, maybe not growing as fast as it normally would with higher inflation. Well, let's take all this and put it into the realm of how would the Federal Reserve respond to this? Think of Jerome Powell, the chairman of the Fed. They're looking at this chart. Here it is, the Fed funds interest rate. You can see in blue, we're currently at 4.3% as we sit here this summer with the Fed funds rate. Now, is this good or is this bad? We'll take a look at the gold line. You know, economists should always have gold lines on their charts. The gold line is the 3% neutral interest rate. Now, what do we mean by neutral? Well, that's where the Federal Reserve is not trying to stimulate the economy with low rates or restrain the economy with high rates. All right, well, let's take a little rundown memory lane here. Look at where the Fed funds rate has been in the last 5 years. Notice in 2020, 2021, the Fed funds rate was close to zero. If we kind of use an analogy here, think of the economy like a car. If you want your car to go faster, what do? You press on the gas. So notice here in my little green box there, the Federal Reserve was accelerating the economy by having interest rates below the gold line. They're pressing on the gas, basically the floorboard, to get this economy moving out of the recession. Then they raised interest rates by 5.25 percentage points, the fastest in 40 years, starting in March of 2022. Basically, the car was doing 100 miles an hour. They had to slow the car down, so they raised interest rates, or basically put their foot on the brake. So now the Federal Reserve is braking the economy by having interest rates above that gold line. And I want to point out, this is just kind of a theoretical construct. Economists just believe 3%. It could be 3.2, 3.5, the neutral rate, but let's just go with 3%. They raised interest rates all the way up to 5.35 in July of 2023. Then in September of last year, 2024, they began lowering interest rates, and they lowered it from September to December to where we're at today at 4.3. The big question going forward, which we have to look into, is what the business environment is going to be, is what the path the Federal Reserve will take with these interest rates. So notice I've drawn on the chart path 1, path 2. What's path 1? Well, that's where the Federal Reserve is more focused on the labor market, thinking, we really need to lower interest rates to that goal line of 3% because the economy may be slowing down with some of these policies put in place or whatever. If we're going into recession, we should lower interest rates pretty quickly. This is the path Donald Trump wants to take. Path number 2 is, we'll lower interest rates, but let's take 2 years to get the interest rate down to that gold line here because we're more focused on inflation, more worried about inflation. So we'll kind of go through some economic charts, figure out what path the Federal Reserve may be looking at taking for the next 2025, 2026 years here. All right. Well, first of all, how is this impacting the economy? The fact that the Fed is putting their foot on the brake. Well, take a look at this chart. This is consumer credit. These are the type of loans that credit unions make. We make credit card loans, automobile loans, RV loans, motorcycle loans. So this is all consumer credit. And this chart in blue looks at the percent change from a year ago. Look at it right now. It's in negative territory, meaning consumer credit, people are paying off their loans faster than they're taking out new loans. This is one important chart that shows, when the Fed is pressing on the brake, it can really slow credit growth at, say, banks and credit unions and finance companies. So this is one chart that shows, the Federal Reserve has massive power in controlling how much loans are being made. My next chart actually looks at just credit unions, but this also includes mortgage data, so it's just not consumer credit. But notice you can see right now credit unions are growing their credit about 4.8% at an annualized pace here, which is below the 7% long-run average. Notice it's weak today because basically the Federal Reserve has interest rates higher than normal, but it's also weak because of what happened in the past. If you notice in the year 2022, we had loan growth of 19.1%, massive amount of loans and say automobile loans, mortgage loans. Well, a lot of those auto loans are being repaid now. It's been 3-4 years. Basically, the amortization of these loans is accelerating and a lot of the repayments are coming in quickly. And that's also depressing overall credit union loan growth. So we're only at about 4.8%, 7% is the long run. So we're a little bit weak when it comes to loan growth. Looking at banks, do they have a similar picture? And the answer is yes. Take a look at our bank lending growth. That's only about 3.6% year over year. If we're looking at from April 2024 to April this year, they're below their gold line or long run average of about 5.7. So when the Federal Reserve has interest rates above neutral, we see loan growth being restrained in order to stop people from borrowing and spending so much, and that brings inflation down. Moving on to my next chart, where do we expect the economy to be? Are we expecting a recession next year in 2026? The answer is no. If you look at those last two bars on this chart of U.S. economic growth rates, we're forecasting 1% this year, 1.5% next year. Now that's weak. Why would I call it weak? Well, we're below our gold line on this chart of 2%. Normally or naturally, the U.S. economy grows 2%. So this is a little bit weak. You may say, Steve, why are we forecasting weak growth for 2025 and next year? Basically, my red box answers that question. Because of the ongoing trade war that we have with the rest of the world, we'll see a little bit less exports to the rest of the world. And of course, higher prices from tariffs will reduce people's spending power. Number two, the long and variable legs of monetary policy. This is the phrase Jerome Powell likes to use to say, having interest rates high today, say in the summer of 2025, will still be impacting the economy, 12 to 18 months into the future. And then number three, slower labor force growth. One way an economy grows, to say this 2% growth figure, is by labor force growth. But as we know, we've shut down the southern border. We have a lot fewer immigrants coming in this country. So that's fewer people, say, working in the construction industry, agricultural industries, hospitality industries, and that will slow the overall economy. Notice we're not forecasting a recession, but there are some economic risks out there that could actually lead to recession. Risk number one, a worsening trade war. If we have more tit for tat, retaliatory type tariffs with the rest of the world, that could slow down our exports, cause prices to rise in the United States. Number two, the Federal Reserve too slow in lowering interest rates. If the Federal Reserve keeps their foot on the brake of the car for too long, that could slow the economy down and basically stall it out. Number three, a decrease in stock prices. As we saw with on April 2nd of 2025 when Trump instituted the retaliatory tariffs, basically we saw about a 20% drop in stock prices. Stock prices have rebounded since then because a lot of the tariffs have been kind of removed or been put on pause. But if we did see a big decrease in stock prices, people would experience what we call a negative wealth effect. And when they do that, they typically spend less and save more. Number four on our list, we have kind of two wars in the world, the Russia-Ukraine war, Israel-Iran war. Whenever there's wars, there's always risk that they could escalate and get out of control, reduce consumer confidence, which reduces spending and borrowing. Number five, a rise in energy prices could always cause a recession. And then the last one, a little closer to home for banks and credit unions, lower quality office property. As we know, because of COVID, a lot of people are still working at home, not coming back to the office. So a lot of lower quality commercial office property has very low occupancy right now. And of course, if it's not being occupied, the owners are not collecting much rent. And if they're not collecting rent, the pricing of their property is starting to fall. Well, when it's time to refinance at the local bank or credit union, refinancings are dropping, or we're just seeing the owners of these properties come in and basically turn the keys in, which is increasing loan losses on these commercial properties, which strains the banking system and could cause the economy to slow down. Moving on, we just looked at these Fed funds interest rate, which I have in this chart here. You can see it's at 4.3. But let's talk about long-term interest rates. This red line is the 10-year Treasury. And notice they're basically the same. The 10-year Treasury bond rate is the same as the short-term Fed funds rate, which is rather unusual. Notice in the last, say, 8-9 months, the black line, the Fed funds rate, has fallen while the 10-year Treasury has risen. All right, that doesn't make a lot of sense. But why are long-term interest rates rising? Well, number one, expectations of higher inflation. Because of all the tax cuts and the deportations, and the tariffs, we could see higher inflation, which typically pushes up long-term rates. Number two on my list, expectations of higher future short-term rates. Maybe the Fed is going to have to keep interest rates higher for longer. And as we know, long-term rates are just the average of future short-term rates. So if future short-term rates go up, long-term rates go up. Number three, we just have a strong economy and rising productivity. That productivity growth was very strong last year and continues to be so. Could be due to AI, artificial intelligence. A lot of credit unions are incorporating that into their business right now, and it's boosting productivity of workers, slowing hiring at credit unions. Number four, investors shortening maturities with expected higher rates. Just the act of selling long-term bonds, buying short-term bonds, reduces the price of those long-term bonds and raises the interest rate on that 10-year bond. Number five, continuation of quantitative tightening. The Federal Reserve is still reducing the size of their balance sheet in order to kind of slow down the growth in the money supply below normal, and that's basically keeping interest rates high. And number six, tariff retaliation. We've heard of Japan and China maybe starting to sell their treasury bonds, which pushes down bond prices, but pushes up bond interest rates. And that's in retaliation to our tariff policy with them. So it's interesting to see the 10-year Treasury rate rising while the Fed funds rate is falling. Here we have a chart looking at the credit union yield on assets, but I have the 10-year Treasury interest rate, as we just saw put up on this chart, going all the way back to the year 2001. And against the 10-year Treasury rate, let me pop up the credit union yield on assets. Notice there's a strong correlation. When the red line goes down, the blue bars come down, or credit union yield on assets. Where are we today? Well, in the first quarter of this year, we hit 506 as our yield on assets. So that's basically we're earning, $5.06 for every $100 in assets that we have under management. What's the long run average? Well, let me put in a goal line of about 4.5. So we're a little bit above long run average right now, which is good. But basically, we expect this to remain flat or actually decrease going into next year if the Federal Reserve lowers interest rates. And we'll see about that in a minute. But basically, we're a little bit above the long run average, which is good for credit unions. How about the labor market? How is that doing? The job situation? Well, as you see on my chart, as of June of 2025, the unemployment rate was 4.1%. You could say, is that good or is that bad? Well, 4.5 unemployment rate is what economists believe is full employment. So we're below that, meaning we have a tight labor market, or the demand for labor by businesses is greater than the supply of labor by household. So it's a tight labor market. Wages are rising a little bit faster than normal. And basically, we've been this way now for about 3 years, where we've had a very, very tight labor market. How does this impact credit unions? Well, notice I've added a blue line to the chart. The blue line is credit union loan delinquency rate. Notice we're at about 0.8 right now. What would be normal? What's kind of the long run average? Well, I'll put that up on the screen. My purple line shows the natural or normal delinquency rate for credit unions is about 0.5%. Translation, for every $100 in loans, 75 cents are delinquent. We're a little bit above that right now, not too much, but it was a little bit higher. But we are kind of right around the normal. But what about charge-offs? Looking at asset quality or loan quality, let me put up a chart looking at the unemployment rate again. Like I said, we're at about 4.1%. To this chart, let's add a red line, which is the credit union charge-off rate. Right now, we're charging off about 82 cents for every $100 in loans. That's a little bit high. Why is it high for these credit unions? Normally, 50 cents would be charged off for every $100 in loans, which is my goal line I've just added across the chart. Why is it up? Basically for these reasons. Number one, falling real wages. Inflation has been greater than wage growth for the last few years, putting stress on people's budgets. Number two, high rent inflation. If you're young, maybe low income, and you rent an apartment, rents have been rising faster than overall prices, leading to tight budgets. So you're always going to pay your rent before you pay your credit card or auto loan. Number three, student loan payment resumption. Maybe some students weren't ready to start repaying their student loans, $200, $300 a month. Hey, it can make you be late on your credit card. Number four, just higher interest rates on credit cards, home equity lines of credit, adjustable rate mortgages. As if you have an adjustable rate credit product, people are paying more interest to their bank or credit union, and that puts financial strain on their budgets. Number five, just slow loan growth. This is the denominator effect. Remember, this is a ratio, a numerator and denominator. And what's that old joke? There's a fine line that separates numerators from denominators. Well, the denominator is not growing very fast right now. Number six, high insurance costs. Because we've had all this inflation in the last few years, insurance premiums have gone up significantly. I'm sure a lot of you have opened your car insurance premium bill and said, whoa, look at the big increase in cost there. Well, some Americans can't afford to have their collision coverage. So the idea would be this. If I have a car accident with you, I may have my liability insurance coverage, which pays for your car to be fixed, but I don't have collision coverage that fixes my car. So I stop making payments to the credit union. They repossess my car, but it's totaled. They're not getting much for it. And then number six, just walk away auto repos. A lot of Americans are saying, you know what, my car is underwater. Car prices have been falling the last few years. I don't need it anymore. And they're just turning the keys into the credit union and saying, I don't want this anymore. And car prices have been very low. So we're not getting much for them at auction. So these are the top 7 ways why the charge-off rate is kind of abnormally high, even though the unemployment rate is abnormally low, which seems a little counterintuitive. Moving on then, what about inflation? Finishing up our Federal Reserve board meeting here, the most important thing the Federal Reserve will look at is the inflation rate. This chart is what Jerome Powell has embroidered on his pillow when he goes to bed at night. Right now, inflation is running year over year at about 2.7% when we use the core PCE measure of inflation, which is the Federal Reserve's preferred choice of an inflation gauge. They want inflation to be at 2%. That's my goal line on my chart. And you notice for about the last year and a half, we've been kind of stuck in the 2.6, 2.7% range here. And it did tick up a little bit here in June. You can see the red line slightly moving up. Is that the first signs of the tariff inflation coming? Well, the Federal Reserve's worried about that. They're worried about the path that this red line will take into the future. Will it be going up? or will it be going down? If it goes up, the Federal Reserve is going to have to keep interest rates higher for longer. If this starts to move down to the 2%, the Federal Reserve can resume lowering interest rates to that target of 3%. So let's bring it back to our meeting here. Here it is, the Fed funds interest rate. We saw this chart earlier. Remember those two black dotted lines on the far right? Want path number 1 or path number 2? Which path is the Fed most likely to take? Most economists today believe it's going to be path number 2. That we will keep lowering interest rates, maybe 50 basis points this year in 2025, and then 75 basis points next year in 2026. But they'll do it a little bit slower because they're more focused on inflation. So they will lower rates, but they'll take their time in doing it. They will not choose path number 1. All right, moving on then. What about all interest rates? What I have here is a chart called the Treasury Yield Curve. Now, what's a yield curve? If you look at the horizontal or bottom axis, it shows different years to maturity of, say, different investments that your credit union could buy. On the left side axis, you have the yield to maturity. What's the interest rate? Notice the blue line represent what interest rates looked like back in March of 2022. Now, why did I pick this date? Well, that was the day before the Federal Reserve started raising rates. We call this a normal yield curve because interest rates on the left are lower than interest rates on the right. This is a nice tool economists use to figure out how do credit unions actually make money. Well, we do something called the carry trade, which you see in green, in my green box here. Basically, that's borrow short term, say issue a 1-year CD to your member, and then lend long term, make a 5-year car loan. So borrow 1 year, lend 5 year. Well, that allows us to buy low, sell high when you have an upward sloping yield curve. So this blue yield curve is very favorable for banks and credit unions. We can buy low, sell high. By March of 2023, when the Federal Reserve raised interest rates in the fastest in 40 years, basically we went to the red curve. That's an inverted yield curve where short-term rates on the left are higher than long-term rates on the right. This typically signals an upcoming recession. Why would it cause a recession? Well, it's bad for banks and credit unions. When I say it's bad for banks, think about Silicon Valley Bank, a $210 billion bank that went out of business basically in March of 2023. Well, why is it bad for us to have an inverted yield curve like this? Well, one, the carry trade breaks down about buying low, selling high, borrowing short-term, lending long-term. 2, liquidity risk. When interest rates are this high, we lose deposits to, say, money market mutual funds. Well, if we don't have those deposits, that leads to a credit contraction. We stop making loans if you don't have those deposits. And so it's the idea of banks and credit unions stop lending. And as you know, our society is based on credit. When people buy a new car or house, they go out and borrow money typically for it. And that slows the economy down. All right, these are nice yield curves to show the blue yield curve, which is good for credit unions, the red, which is bad. What do we have today? Let me put up a green line. That's June of 2025. Notice it's relatively flat. Basically, it's come down from the red in the last few years, but it's still flat. Not the best interest rate environment for credit unions. So we expect our overall earnings to be under pressure this year. And we'll see that in a chart looking at credit unions' net income and return on assets. Moving on, what about our money supply? The good news here, our money supply is growing again. If you notice on this chart, this is looking at the growth rate of our money supply, which is called M2, because us economists are really creative. We just call it M2. But what's M2? As you can see in my little box there, it includes all the currency in circulation, checking deposits, savings accounts, money market CDs. But if you'll notice, those 4 middle ones, which I've just circled in red, those are credit union bank deposits. So if you're ever driving along on the road and you hear on the radio, hey, our money supply is growing or shrinking as defined by M2, think about it's really talking about credit union bank deposits. Well, as you see, by May of 2025, we're growing 4.5%. Now, is that good or is that bad? Well, let me put in a gold line. The long run average is about 5.4. Why do you always want your money supply growing 5.4? Well, the economy grows 2%. We typically have inflation of 2%. Add those two numbers, you get 4. And then people just like holding more cash in, say, checking, savings account at about a growth of 1.4. So if you add 2 inflation, 2 economic growth, 1.4 more cash holdings, you get 5.4. Notice in a recession, the Fed will increase the money supply like they did in December 2001, where money supply grew 10.4%. Basically, you increase the money supply, push down interest rates, People borrow more, spend more, boom, you're out of a recession. They did that also in January 2009. Money supply growth went to 10.3%, basically double the normal gold line of 5.4. And then notice what they did with the last recession, the COVID-19 recession back in 2020. The money supply grew 27% year over year pace by February 2021. Now, Milton Friedman, the famous economist, said this quote here: inflation is everywhere and always a monetary phenomenon. Translation: you print money today, you're going to get inflation tomorrow. And by June of 2022, about a year and a half later, we saw the fastest inflation we had in 40 years. So what did the Federal Reserve do? They basically had money supply shrinking back in 2023, which kind of reminds me of the famous quote by Warren Buffett. He said, when the tide goes out, you can see who is swimming naked. Well, basically, who was swimming naked in 2023? Well, you had Silicon Valley Bank, Signature Bank, Silvergate Bank, three big banks that went out of business because the money supply was shrinking quite rapidly. The good news is we're back to 4.5% today. That is leading to faster deposit growth this year and into next year. Why? Take a look at this chart. We dipped down in 2023. We're back here in 2025. Take a look at bank deposit growth here. Notice the similar picture on this chart. This is bank deposit growth year over year. Normal is about 6.3%. Notice what happened to bank deposits. They shrank in 2023 because our money supply was shrinking. They're growing right now about 3.4%. But notice they still have weak deposit growth, weaker than their normal 6.3%. So it's a little bit hard to make loans if you're not getting in the deposit. So loan growth is still relatively weak. This is one of those economic headwinds it's good to be familiar with when you try and do your strategic planning. How about credit unions then? Let's bring this all back to credit unions and our balance sheets. On the left, we have listed our assets. On the right are our liabilities and capital. Our main liability, of course, is our deposits of money given to us by our members, checking accounts, savings accounts, money market CDs. How fast do we expect this box to grow this year? Well, here it is. For 2025, we're forecasting 6.5% deposit growth. What's normal? Well, notice my goal line, about 6.6%. This is going to be better than the last 3 years. The last 3 years have been relatively weak deposit growth at credit unions. Remember, we talked about that inverted yield curve where money was leaving credit unions going to money market mutual funds, but also a lot of people just weren't saving because of the huge explosion in savings they had in 2020, 2021. Why was deposit growth so strong in those years? Well, remember, we had the COVID-19 crisis. The government sent out stimulus checks, about $3,200 to the average American. What did the Americans do with that money? Well, they deposited at their credit union bank. So the huge deposit surge in those 2 years meant we had weak growth in the following 3 years. For next year, 2026, we're forecasting 7% growth, so a little bit above the long run average. All those deposits coming in, that's good for credit unions. It'll help us make more loans because we are, in our name, a credit union to make credit. Moving on to my next item on our balance sheet here. What's happening with borrowings right now? Are credit unions still borrowing a lot of money? Well, the answer is no. Basically, if you take a look at this, in the last few months, basically credit unions are paying off their borrowings, relying less on debt or wholesale funding. They're relying more on the retail deposits because they're starting to come back again. But notice in 2022, we saw an explosion in borrowings because of that inverted yield curve and tight liquidity at credit unions. So the bottom line is right now, credit unions are kind of deleveraging their balance sheet. When it comes to the last category on the right side, then the bottom right there, the equity, or what we call net capital, which is your undivided earnings, regular reserves, but also this category called gains and losses on available for sale securities. This has been an important topic in the last few years because when the Federal Reserve raised interest rates, the price of your bonds fall. And basically, even to this day, we've lost about 4% of our investments because of the increase in interest rates pushed down the price of our investments. So it had a little bit of effect on our equity, reduced our equity here. And just to show you the drop in equity, take a look at this chart. Here's credit unions' equity to asset ratios. And basically, starting with COVID, we saw a drop in our equity asset ratio from 11.2 to 10.3 because of the denominator expanded greatly from all the stimulus checks money, as I mentioned earlier, $3,200 sent out to the average American. So it reduced the ratio here. The assets exploded. Then what we saw in 2022, when the Federal Reserve raised interest rates, reducing the price of our bonds, we saw our equity fall here to 8.8%, which was the lowest in credit union history. The good news is we've recovered up to 9.7% today. Moving on, then, what do we do with all this funds then? We call these our source of funds, deposits, borrowings, and equity. Well, we put some in cash, or what we call reserves at the Federal Reserve, in order to clear checks. Next, we buy land, building, and equipment, or our fixed assets. And then we also buy some investments. Less than 1 year maturity, 1 to 3 year maturity, greater than 3 year. Just kind of go back to Silicon Valley Bank. The reason they went out of business is because in their investment portfolio, they were heavily invested in greater than 3 year maturity investments. So when the Federal Reserve raised interest rates in 2022, they had a huge drop in the price of the value of their investments, which basically caused them to collapse and be unstable and had to be taken over by the FDIC. Remember I mentioned earlier about those 4% of investments are still been lost due to the rise in interest rates pushing down the price. So we still have that effect. I like to stop and look at the sum of the cash box in the investment box here. This is kind of money that we could loan out if we wanted to have some of these investments mature. What if we added cash and investments and looked at a percent of total assets? Well, that's this chart here. We call it credit union surplus funds. Notice we're down to about 25.7%. One of the lowest we've seen in this new century here. So very tight liquidity still at many credit unions, which is one reason why lending is still under pressure, because a lot of credit unions just don't have a lot of excess liquidity sitting there. This is down from the 36% we saw back in 2021. Remember, that's when those stimulus checks came rolling in, and we were in a recession where typically people save more than they want to borrow and spend. So we still got a little bit of tight liquidity showing by this chart for the average credit union in this country. Now we come to the big category. Remember, we are a credit union. We are basically money traders. We buy and we sell money. Well, this is the money that we're selling, making loans for commercial loans, auto loans, home loans, credit card loans. What do we forecast for this? Well, basically, we expect that loan box to be growing about 5% this year, 6% next year. But notice it's still below my goal line of the long run average of 7%. Why are we forecasting a little bit lower? Because interest rates are still a little bit higher. That's number one. The Federal Reserve still has their foot on the brake, if you will. Also, a lot of credit unions still have very tight liquidity. They're not able to lend as much as they would like to because their loan to asset ratio is already pretty high. And also just because of what happened in 2022, a lot of those loans we made then are being repaid now. And so once again, we're getting a lot of loan repayments coming in, and that's just making it harder to have overall loan growth. So the good news is we're coming out of that 2024 year where we only saw 2.8% loan growth. That was really weak. That was the lowest since basically 2011. Very weak loan growth. But we're basically, we use that term in economics, reversion to the mean. We are coming back to that goal line of 7% there. And so next year we'll be pretty close to it at 6%, but still a little bit below. Moving on then, if you take a look at this picture, if you ever took an accounting class, you know that the assets on the left are supposed to equal the liabilities and capital on the right. But you notice the way I've drawn my boxes, the boxes on the left are a little bit longer than the boxes on the right. So did I do something wrong? Well, no, I just left something out. Let me highlight it at the bottom left. Notice in purple, I have what's called the allowance for loan loss. Now, what is this? Well, this is the money we've set aside for potential bad loans. Loans that people just don't pay us back. As you know, people get hit by buses, they get divorced, they have an uninsured medical expense, and they just don't pay back their loans, either commercial, auto, home, or credit card. Well, how much money have we set aside, or out of the total red loan box, how much do we expect that these loans won't be paid back? Well, basically, I have a chart here showing what's called the allowance for loan loss as a percent of loans. If you go all the way back to, say, 2014, we used to set aside 94 cents for every $100 in loans expected wouldn't be paid back. Notice that drifted down nicely through 2019 to 84 cents for every $100 in loans. But notice by 2020, it jumped. We had to set aside $1.10 for every $100 in loans. And why was that? Well, that was your COVID-19 pandemic. We're in a recession. 1.5 million people died during the pandemic due to COVID, and so they weren't able to get paid back. But after COVID, most of us got vaccinated, the provisions and the allowance account fell to 72 by 2022. But look what happened. In 2023, we saw a big jump in the allowance for loan loss. Now, is that due to a oncoming recession? Well, no, it's just due to accounting change, which I've noted up on the screen. This was the current expected credit loss model. The accountants basically just changed the rules on us and said, this is the new way to basically calculate your allowance account. And we all boosted up. Notice it has been drifting higher in the last few years. We're up to $1.29 today. In 2025. We only expect it to stay around this because we don't expect a recession. In a recession, you might expect these bars to rise. Moving on then, what's the bottom line? This is looking at credit union net income as a percent of average assets, or what we'd call our ROA. Now, back in the old banking world, down in the 50s and the 1960s and 1970s, the goal was to hit a 1% ROA, or return on assets. Translation, for every $100 in assets under management, earn about $1. Earn $1 for every $100. Well, notice we haven't been hitting the, say, 100 cents or 100 basis points on this chart in a very long time. Notice the gold line, kind of the new 21st century average is around 78 basis points. That is the current long run average. Last year, we only got 24 basis points. Why? We saw a big jump in operating expenses. Because of all this inflation, operating expenses went up very quickly. Also, provision for loan losses were rising because of the new accounting change. And basically, we had kind of low last year. Going to the first quarter of this year, the latest data out, we're earning about 65 basis points. But what are we forecasting for, say, the next 2 years? For 2026, we're forecasting this could rise to 75 basis points, or 0.75 ROA. We do expect it to rise a little bit, but still be below that gold line of 78 basis points, or earning 78 cents for every $100. Why is that? Well, basically, we still have a relatively flat yield curve, meaning our cost of funds are still relatively high relative to the yield on assets. So we won't see as big as margins. Still, we still have inflation pushing up our operating expense ratios. So the next year in 2025 will still be a below average year for credit unions' net income to average asset ratios. Moving on then, here's the picture then of a credit union. Notice I've got this green arrow up on top with a little dollar symbol, dollars flowing in. And then at the bottom left, the green arrow flowing out. And this is basically how a credit union works. Deposit dollars flow in on the top right. Those deposit dollars flow out in the form of loans in the bottom left. And basically, we want to keep the money flowing in. It's kind of like the analogy of your heart. Blood flows into your heart, gets reoxygenated through the lungs, and then flows back out of the heart. Well, that's how a credit union works. Deposits flow in, we kind of reoxygenate the money a little bit and lend it back out again. So we are just like a heart, and that's why a lot of economists call banks and credit unions the heart of the economy. Now, they say if you want to sound smart when you do these presentations, throw in a little Latin. So here's my Latin phrase on the side left there. Non progredi est regredi. Translation, to not go forward is to go backward. What does that mean for us? Basically, if you're not growing, you're dying. We need these boxes to keep growing roughly 7% a year. It's kind of the long run average for credit unions. I kind of call credit unions the 777 of our society. Deposits normally grow 7%. Loans typically grow 7%. And even our equity over the long run grows 7%. Hence the 777 for credit unions. So we want to keep this balance sheet growing. That achieves economies of scale. Of course, economies of scale gives you lower operating expenses relative to assets and become more efficient, more competitive with other banks, finance companies in the new tech industry, the fintechs out there. All right, so what's the overall summary going into looking for strategic planning going into 2026? This is what we have. Below trend economic growth in 2026, about 1.5%. Remember, 2% is normal. So not bad, but it's not basically where we like to see it. Number two, inflation will remain above target for the next 2 years, meaning the Federal Reserve is still pressing on the brake, but they're pulling their foot off of the brake. And they will be hitting, say, 3% on the Fed funds rate out in the next 18, 24 months. Number three, unemployment rate we expect to rise to that natural rate of 4.5% in 2026 to bring the labor market back into equilibrium. Like I said before, right now the supply of labor is less than the demand for labor, keeping wage growth higher than the Federal Reserve would like. Number 4 on our list, what's our forecast for the Federal Reserve? Short-term interest rates falling 50 basis points this year, 75 basis points in 2026, which will get us very close to that 3% neutral rate. And then number 5 on my list, credit union loan growth below trend in 2026, about 6%. Remember I said normal is 7%. 2025, we're forecasting 5%. So a little bit weak loan growth. Why? Because interest rates are still a little bit above normal. Basically, a lot of credit unions still are tight liquidity. The loan to asset ratios are still above normal, meaning that surplus fund ratio is below normal. So not bad, 6%. Like I said, 7% is normal. And then number 6 on my list, credit union return on assets, or our bottom line. We expect it to rise to 75 basis points, or 0.75 next year in 2026, which would be pretty close to its kind of the new long run average, but below the 1% that we used to make back in the 50s, 60s, and 70s. Why are we kind of hitting 75 as the long run average now and not the 1% ROA? Well, because of competitive pressures. The world of banking and credit unions and finance companies has got a lot more competitive over the last 20, 30 years, meaning it's really hard to hit that old rule of thumb of the return on assets of 1%. So 75 basis points, that's not bad. We would like to see it a little bit higher. But once again, the flat yield curve will keep net interest margins a little bit lower than they otherwise would have been. And inflation is keeping operating expenses rising a little bit faster than normal. But the good news is a lot of credit unions are implementing AI, artificial intelligence, into their back offices, reducing maybe their call staff, their how many loan officers they may need, or tellers, things like that, which is slowing down the operating expenses at credit unions because they're not bringing on as many people as they normally would have. All right, overall then, that is my economic update. I hope you enjoyed it, and I hope it helps you creating your 2026 strategic plan. Thank you.